controllable factor in how long your retirement funds will last you is your taxes. Well, maybe besides your spending habits. And it doesn't help that my fellow Oregonians, we have one of the highest state income tax rates in the country. So in this video, I'm going to summarize 7 discussions your financial advisor should be having with your CPA to save you on taxes. Tip number 1, tax strategic withdrawals by drawing from the right accounts. Let's say you have $500,000 in your retirement accounts. And after your pensions and your Social Security, well, you still need another $40,000 distributed to you every year from the $500,000. So how are you going to withdraw that money to make it last as long as possible? If you have, let's say, a tax deferred account, that's a fancy way of saying IRA or 401k, which is taxed at ordinary rates on withdrawal, and you have an ordinary taxable account, which is mostly taxed at capital gains rate, and you have a non-taxable account, like a Roth IRA, which account do you draw your $40,000 from? The answer will probably be some from each of them. And that's because by keeping your tax bracket low enough, using the tax-free account with some from the tax-deferred account, your distributions from the taxable account, which usually trigger capital gains, may be taxed at the 15% capital gains rate or even 0% capital gains rates. By keeping your CPA and financial advisor working together, those savings compound into earnings. You can make your retirement savings last longer. So tip number 2, when making large irregular withdrawals for, let's say, a purchase of a home or a family vacation you're going to pay for, do you take the funds all at once or do you stagger the withdrawals over multiple years? Let's say like one November you determine you have a cash need of $100,000 from your tax deferred account sometime in the next few months. And your other taxable income during the year after deductions is about $25,000. So if you took $50,000 in December and $50,000 in January instead of $100,000 in December, that would have saved you over $11,000 in taxes. That's of course because as your taxable income and withdrawals go up, the tax brackets get steeper. So again, when your CPA and financial advisor are working together on the timing of your withdrawals, this is tax savings that will be reinvested and compounded for you in your later retirement years. Okay, tip number 3, this is cool. The new Tax Cut and Jobs Act, now it completely wiped out and eliminated the bottom section of the Schedule A, the itemized deductions. So this was the section for your financial advisor fees to be deducted. So the deduction is gone, right? Or is it? The federal regulations of the IRS says taxpayers may capitalize amounts paid to acquire or create intangibles if they are facilitative costs. In other words, have your advisor create an allocation of his fees between financial planning costs, purchasing, and costs of selling the securities or funds. This way, you can increase the cost basis in the stocks when you buy and sell them. The advisor needs to carefully document the allocation and provide reasonable justification for any such calculation. But by providing this information to the CPA, you can beat the door closed by the new tax law and open another door for yourself to save taxes. Okay, tip 4 of discussions between the CPA and the financial advisor. Part of a balanced portfolio, especially during your later years, should include some bonds for stability. But what kinds of bonds? Municipal bonds, of course, pay tax-free interest, but they have lower payouts. While other bond interest is usually subject to ordinary income tax rates, but they pay higher amounts. So if you're in a high enough tax bracket for the foreseeable future, there should be a calculation made by the CPA to help make the advisor's decision. For example, if you're comparing a 3% bond and a 2.5% muni bond and your CPA tells your advisor you expect to be in the 35% tax bracket going forward, the lower rate muni bond actually yields an after-tax return of over 0.5% higher. Now keep in mind, this calculation needs to be updated annually. Tax tip number 5, when is the right time to sell stocks that are down and you don't see a recovery before you need to sell them? Alternatively, if you do see a recovery, you can sell and repurchase after 31 days and use the loss now. Your CPA should be working with your financial advisor to push your taxable income into lower tax brackets where appropriate. This is especially true when you have a high income year and you could have a tax surprise in April. You don't want that. You also could risk jumping from the 24 to the 32% bracket, and that's the highest middle income spike on the tax tables. And this is more so when you sell a business or you're selling a piece of property. You got to be really careful those years. Okay, tip number 6. There are so many alternatives for retirement accounts. You could use the 401k, traditional IRA, Roth IRA, 529 educational account, SEP, and there's new kitty tax rules looming. It's more important than ever to make sure your CPA is contributing to the discussion of your financial advisor to maximize the tax benefits of your contributions. Additionally, as I've talked about in another video, it might make sense to do a Roth IRA rollover, but that decision should never be made without some input from your CPA. Okay, tip number 7. Taxpayers are required to pay their taxes in the year the money is earned, of course, and pay additional taxes for any deficiency or get a refund for overpayments. Since there can be interest charged for underpayments and no interest paid for overpayments, getting these numbers right, it's important. Your financial advisor needs to let your CPA know what trading decisions he is making to avoid unpleasant surprises in April. Okay, in all of this, keep in mind you've worked hard for your money, right? So don't let any of your wealth evaporate because of careless tax planning or miscommunication between your CPA and your financial advisor. This could hurt your portfolio. Get the long-living and valuable portfolio you deserve by making sure at least these 7 discussions are happening throughout the year between your CPA and your financial advisor.